Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Most of you are making mistakes with your money that could cost you tens, if not hundreds of thousands of dollars for your retirement. Here's the sad thing, you don't even know it. Stick around over the next half an hour. What we're gonna do is tell you what mistakes most of you are making so you can avoid them so you have more money. Welcome to Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. As always, with my partner, the big man, Big Al Clopine. He's sitting right over there. Got a great show lined up for you. We're gonna talk about the mistakes, simple little mistakes that I have found in just about 20 years of doing this business that can totally derail your overall retirement. We're gonna dive into the specifics of this so that you are a better informed investor. What I did over the last couple of weeks, I don't know, we're down here in Southern California, San Diego, and so I went to the streets and I wanted to talk to you to figure out exactly what do you know about retirement? Do you understand these mistakes that people are making? Are you making them individually? So that's what's on my mind today. We're at Comic-Con 2014. We're going to walk around and ask the superheroes how much money they need to retire. And I recruited Landon Flint here.
I know, I'm kind of worried about all these super worlds that they have going on because everybody's here, but what happens tax-wise? They lose their capes, they do this, they do that, like they should be writing this off, they should be planning for retirement. You can't be a superhero forever.
When you get done destroying the world, you have a retirement plan in place. He's going to take what he wants when he wants it, folks. How much money do you think you need to retire?
Well, I drive a Corvette, so thinking $12 million.
$12 million.
I got high taste, guys.
All right, so what is your plan to accumulate the $12 million?
I take jobs and cross people off lists.
Okay, so she kills people for the $12 million.
We're hoping that the Death Star has a pretty good 401k, so we're kind of counting on that, but we'll see about a couple years from now.
Hey, we're down here now, waiting for Brad Pitt. I think Brad Pitt's going to arrive any second, and we're going to get a quick interview. He said he's going to come on Your Money as well, so we're just going to wait around for just a couple of seconds. So what is your plan to save the $2 million to use during retirement?
I can have all my evil little monkeys running around, doing side bits, maybe lawn work.
So do you use magic when you plan your retirement funds?
Not yet. 401k is good enough area.
I don't have to save anything because cost of living is very cheap in Sesame Street. Very cheap.
She's a Smurf. How much money does a Smurf need to retire?
We just need to be happy. That's all that matters.
Okay. After you're done saving the world, what's going to happen to you? Are you going to retire okay? Are you planning for retirement?
Not anytime soon.
What you should do when you do bust those criminals, take that money, start retirement accounts for the community maybe?
Go to Hawaii.
No. The poor need the money. The poor need the money.
I guess no one really wants to save for retirement. They're going to take over the world. That's nice in fantasy land, but it doesn't really work in real life, so keep saving. Al, back to you. There you have it, Al.
Comic-Con, they're maybe not quite ready for their retirement, huh?
You know, it's funny. We interviewed, many people. And most people said, you know what, I don't need to save for retirement. I'm just going to take over the world. I'm going to conquer the world. Or you know what?
Sure.
What is really retirement? It doesn't really matter. So
yeah,
that's not reality.
Not really.
So let's kind of dive into reality so to help our viewers to figure out exactly what you need to do so you don't make the mistakes that the individuals that I spent a lot of time with a couple of weeks ago at Comic-Con.
Yeah, let's start with some of these unknown obstacles, which we're going to go over today, and that is high fees inside of your investments. Do you know that some of the investments have annual charges that you're paying? You may not even know it, so that's number one right off the bat. Number two is you may be picking the wrong investments. They may be poor investments. You may think you have good ones, and they may not be the best ones. Some of you are looking for financial advisors, and you may have the wrong advisor. Do you know how to pick the right advisor? We'll get into that today. And lastly, the tax rates of your retirement income dollars as they come out of these retirement plans are going to be higher than you think. So we're going to talk about how to mitigate those taxes in retirement. And Joe, these four things are often overlooked when it comes to retirement planning.
Right. When you look at it, and unfortunately people don't really understand it, because let's just start with high fees for a second. There's zero transparency, it seems like, in the industry. So you really don't understand what you're paying for the investments that you choose. Are you paying 1%, 2%? Do you have an advisor that's also charging you a percentage of your assets? Are you in index funds? Are you in retail mutual funds? Or how about a variable annuity or fixed annuities? There's thousands of different products out there. And the industry is does a very good job of hiding what you're actually paying. So high fees is probably number one on the list of some of the mistakes that people really don't understand what they're doing, and 1 or 2 percentage points of added fees makes a huge difference in their retirement.
Well, I think so too, and actually when you think about it, now the average mutual fund fee according to Morningstar is 1.3%. What does that mean? That means that you're being charged roughly 1.3% per year for that mutual fund, for that fund manager to pick those investments. Now, some fees can be as much as 2 or even 4% or even more in the case of some annuities and high-cost mutual funds. On the other side of the spectrum, did you know that the average index fund is going to be more like 0.3%? So in some cases, your average index fund is going to be roughly 10 times less the cost than what a retail mutual fund, some retail mutual funds, or what annuities and the like would cost.
So when you look at high fees, Al, and you look at, all right, well, here 1.3 is the average cost according to Morningstar. But that's just the expense ratio. Then you have to take a look at, or what are the trading costs in those overall funds? And so when you look at the trading costs, now you have to go to the statement of additional information. Who's heard of that? You have to go directly to the fund company or look it up online. No one's ever heard of the statement of additional information. That's where you find out the true cost of the overall fund. When you look at the expense ratio, the trading, and everything else, and those fees can be very, very high depending on how many trades that portfolio manager's making.
Well, they can. And then when you think about it, so a fund fee of a 1% or 2%, what does that really mean in terms of your overall portfolio? And we ran a little analysis here over 50 years. If you started with $100,000 at 5%, you would end up with $1.1 million after 50 years at 5%. But what about 2% higher? If you didn't have that 2% fee, you would end up with $2.9 million. Almost 2/3 as much again. And this is why when you hear people talking about fees, it really is important, because when you have high fees, you're giving a lot of that away to others instead of yourself in your own retirement.
So here's what we're going to do. Most of you don't understand the fees that you're paying, so we're going to give a retirement income plan for all of our viewers today. We'll dive in and say, are you on track for retirement? Do you have any of these unknown pitfalls or mistakes that other people are making? We want to make sure that you avoid them. Call the number right now. You can come into our office and we'll take a look at everything for you with full transparency. Tell you exactly what you're paying, how much risk that you're taking on in the overall portfolio, and do you have a retirement plan set up? The number's 888-994-6257. Everyone that calls in the next half an hour will get in for free. After that, the phone lines will stop. So call right now, 888-994-6257. We're going to run to a break. Don't go anywhere. We're just getting started. Show's called Your Money, Your Wealth.
It's hard to imagine, even at this point in my life, being retired. I just don't see it. You know, living the American dream of having your house and being able to retire. nobody has a pension anymore. It wasn't like it was in the 60s or 70s where people worked for, good companies and had a pension plan.
I think that's a harsh reality for a lot of people. I think, and I do think that we'll be working until, we'll definitely be working until our probably mid-70s. If I had to unless we can make up some big ground soon.
Election forms. As you can see, there are numerous options to choose from. And remember, this is your retirement, so make your selections carefully.
But most people remember their first 401k meeting as dumbfounding.
Any questions?
I had no idea. I was so confused. I came out of that meeting and I was like, oh my God. It was overwhelming for me, the knowledge that you had to have in order to invest.
Hey, welcome back to the show. That is so common out there, is that you go to your first 401k enrollment meeting and then you really don't understand, what are they talking about? What investments
Yeah, they
do I
start
get
talking
into?
about growth funds, value funds, international, what's a bond, what's a stock, and it's like, man, I have no idea. Just tell me what to do. And
right, and let alone the transparency of everything, of figuring out, okay, well, what investments do I get into, and then what are the costs of all of this? How do I put together an overall portfolio? There's a lack of education out there, and we get that, we understand that. That's why we're doing this show. Let's go to the true-false question and see how you did there.
Here we go. Retail mutual funds generally beat the market because there's a fund manager that picks the best investments available. True or false?
I would say, well, that's true and false, Al. Let's talk about it. Because some advisors or some portfolio managers, all right, can they beat the overall markets? And the answer is yes.
Sure.
And so, is it probable that they do it all the time?
The answer there is no.
Right? And so when you look at, okay, well, on a 20% basis, yeah, well, if you look at the statistics anyway, 80% of retail actively managed funds failed to beat their overall index time in and time out. Can they get lucky 1 year? The answer is sure. Can they get lucky 2 or 3 years? Absolutely. But over a long period of time, the statistics show, the academic studies show, that an actively managed fund just doesn't perform to the overall benchmark. So we believe, why even play that game and pay all those fees to the managers, to the advertisements, all the analysts that are sitting on their overall payroll? It's just a loser's game in our opinion, so that's why we want to reduce, that's why you should reduce the fees as much as you can and look at more of index funds, ETFs, passively managed funds, and the like.
Yeah, no question, and Joe, you've hit it exactly right. Over the long term, you actually do better with an index type fund that has low fees. And you would think, well, wait a minute, isn't an actively managed fund, I've got this fund manager picking only the best stocks? Well, guess what? They're all trying to do that, and it's very difficult for them to beat the market over the long term.
They're just playing with themselves, right? They're just they're battering back and forth.
It's what we call a zero-sum game, which means some win, some lose. But over the long term, their fees are more expensive, and so you don't do as well as an index fund.
You got 80-90% of the trades out there by the big institutions, and all they're doing is trading with each other, right? So it's not one person trying to outsmart another person. It's you trying to outsmart the entire market, or one portfolio manager trying to outsmart the entire market. And you're right, Al, it's a zero-sum game. What we mean by that is that the market only produces X, 10%. So if I do 12%, you have to do 8, and that's usually what happens.
That's usually what happens.
Because so, you do a lot worse than I do.
Well, last year before, I beat you like crazy. Anyway,
let's talk about bad investments.
Yeah, when you're talking your 401ks and retirement accounts, here's what some of you are doing in your 401ks. You're relying too much on company stock. And in 2000, the average was 19% company stock in your portfolio. That's way too much risk. We saw this with Enron. We saw this with other companies. You don't want to have so much tied up in one single stock. The other thing that's happening in retirement accounts is you're taking too much or too little risk. And what I mean by that is that you may be all in, all stocks, and that may be way too much risk because the stock market is volatile. On the other hand, many of you are very conservative, all bonds and all cash, and that's not going to even keep up with inflation.
Here's what happens, Al, is that you look at an individual's portfolio, and then they have most, let's say 30%, 40% all in company stock, and then the rest sitting in cash. So what you're doing here is that you're putting your head in the freezer and then you're putting your feet in the oven and you think you're warm there. No, that's death. That's a death of a portfolio as well. You're taking on so much risk in some component of the overall portfolio and you're not taking enough risk in other areas of the portfolio. That is not diversified. That is not going to get you to where you need to be. You want to really take a look at the options in your overall 401k and make sure that you're prudent with the investments that you choose.
Yeah, the other thing to consider is whether you're investing in retail mutual funds or index funds. And we already talked about index funds being a lot cheaper and generally where you want to be longer term because of those cheaper costs. But realize there are some very high cost investments like annuities, like non-traded REITs, for example. And in this case, you may have a 2%, 3%, 4%. We've even seen a 5% actual annual cost in these investments, and it's very hard to make money when those fees are that big.
And so here's the deal. This is what people need to figure out. Is that, all right, well, maybe I need help with this. I want to take a look at some transparency. What investments should I get into? Well, how do I build a diversified portfolio? Then you might want to take a look at searching for help and finding an advisor. There's different types of advisors that you can choose. So that's an important decision if you want to ask for help. And so you want to look at it, all right, do I work with a standard stockbroker that works for a Wall Street firm? Or do I want to look at a fiduciary that only has to do what's in my best interest? Still, I don't know where we got this statistic, but a majority of brokers are, a majority of the individuals out there that are given advice are still in the stockbroker type model.
Yeah, that's exactly right. It's about 85% are kind of the old commission-based method, and then it's about 15% that are fee-only that are what's called fiduciary. And fiduciary means that that individual needs to act in your best interest. A fiduciary is very important when you're talking to a financial advisor. If you have your choice as to which to pick, you would much rather have a fiduciary because they have to look out for your best interest. These other kinds of stockbrokers and insurance agents and so forth, they are on a suitability standard, which means as long as an investment is suitable for you, it's okay for them to recommend it. And that may or may not be the best investment for you, and so you got to watch that.
Right, so what you want to do is you want to find out and ask some tough questions and say, all right, how are you compensated? Is there any conflicts of interest? And will you put down in writing a fiduciary standard? Will you sign a statement saying that you are going to act in my very best interest? I'm telling you, most big brokerage firms will never sign that. There's way too much liability. But you want to make sure that you understand if there's a conflict of interest, and there will be a conflict, as long as you understand that conflict and both parties agree with that, then I think you're on the right track. That brings some fiduciaries. But well, check out this video. This is by a very large brokerage firm and what his opinion is on the fiduciary standard.
I asked the head of retirement at J.P. Morgan Asset Management why anyone would want to take advice from someone not bound by a fiduciary pledge.
Shouldn't I want to only work with somebody who has a fiduciary obligation?
Not necessarily.
No?
No.
Isn't it better?
It's different.
It's not better?
It can cost more. You may not get any different advice or outcome, and it can cost you more.
Right, but make this simple for the investor.
That is the craziest thing I've ever heard. A fiduciary standard is that you have to do absolutely in the best interest of the client. Did you see his face, Al? He kind of got a little red. He's
he
like,
did.
oh my, what? This is not in the script. What are you talking about?
This is going to be on TV. What should I say?
Get rid of that whole term fiduciary. I don't want anything to do with it. No, it's going to probably cost you more. No, because here's the deal. When you work with a fiduciary, there's transparency. You know what you're paying. When you go with a commission broker, you have no clue. You have no idea what the fees, the cost, the commissions of what that individual's making in most cases. So he's playing, well, no, it's going to cost you more.
Yeah, and then he said you may get the same advice, and it may cost you more. He said the same thing twice.
Work with a fiduciary. They have to do what's absolutely in the best interest of you. Of course, everyone at our firm, Pure Financial Advisors, will put that in writing if you want to come sit down with any of our CFPs. What we're doing today is helping you out, trying to clear the mess of this whole retirement planning. Take advantage of our retirement planning master plan, retirement income master plan. Every week it's something different. Call the number. We're going to help you out. Figure out what you're going to do with the money, how much risk you're taking, how much fees. Work with a fiduciary, 888-994-6257. 888-994-6257. Don't go anywhere. We'll be right back. Show's called Your Money, Your Wealth. Welcome back to the program. Show's called Your Money, Your Wealth. Happy Saturday morning to you. Joe Anderson here, certified financial planner. Big Al Clopine, CPA, Your Money, Your Wealth. Thanks for tuning in. A couple of things. I want you to take advantage of the retirement income planner that we put together for you. There's a lot of mistakes that you're making when it comes to transparency, how much money that you're paying in fees, what's the overall allocation, am I in the right or wrong investments, what are the tax consequences coming from the retirement income that I'm going to receive in the future. If you're retired or currently retired, I encourage you to call the number to get in at no cost. Everyone that calls from now to the end of the show gets in for free. 888-994-6257, 888-994-6257. Or here's another thing. If you do not want to come into the office, come see me around San Diego. I teach a retirement planning course all over Southern California. And if you want to come in from now to the end of the year, go to Your Money, Your Wealth website. You can click on that. You can give you all of the locations I'll be at from now until the end of the year. I think I'm teaching, it feels like, just about every night of the week. So go to Your Money, Your Wealth website, check it out, click the box, and then just pick whatever school that you want, and you're right in line there. So from that, let's get into it. Let's kind of dive back into the true-false question that we did before the break.
All right, Joe, here we go. If my advisor will not put into writing that every recommendation will be made in my best interest, I should find a new advisor. And the answer to that question is absolutely true. There are so many good advisors out there, you really don't need to go to one that's going to be selling you product and making commissions. There's a lot of good fiduciary advisors out there. Of course, Joe and I work for Pure Financial Advisors. That's a fiduciary. We are required to do what's in your best interest, and we put it in writing. But I don't care if you come to us, at least go to an advisor that's a fiduciary so that you can get the best advice. And Joe, I would say this is really one of the most important things when you're picking an advisor.
Right, well, I mean, you look at the clip before, the president of retirement plan for retirement planning for JP Morgan, they asked him flat out, should you pick a fiduciary? And what does he say? He's like, well, they could cost more. Well, first of all, fiduciary has nothing to do with cost. You're looking at putting the best interest in front of the client. That is so key when you're dealing with your money. Here's one thing. There's misconceptions with a lot of products. I'm going to try to explain this because a lot of you are trying to get guaranteed income, and there's a variable annuity out there that says, here, you can get a guaranteed income for the rest of your life. And there's misconceptions on how it's sold because a lot of you come into our office thinking you have a guaranteed 7% rate of return. Real quickly, let me show you how this product works. So if you have a variable annuity, let's say I'm going to put $500,000 into the product, I'm age 55, and I want to draw income at age 65. There is two ledgers on a variable annuity. One is your income benefit. They'll say, I guarantee you 7%. Most people think that, all right, well, I have a guaranteed 7%. I could take out 7%. That's great. Because over 10 years, that money will double. So they look at the statement and they say, hey, I have $1 million. And then they'll say, all right, well, we'll give you a 5% guarantee on the million. And so that's a guaranteed income of $50,000 for the rest of your life. You start out with $500,000 at age 55. Age 65, that's when you want to draw the money. They said, I'm guaranteeing you 7%. After 10 years, you have $1 million, and I'll give you 5% on the million or 50 grand forever, okay? That sounds great. This is just an accounting ledger. This is not your money. It just is a ledger that they use to determine what this factor is. Let me do the math for you. They have my money, $500,000 at 55 to 65. How much money have I received? Zero. So they've held my money for 10 years. Then another 10-year passes. $50,000 times 10 is what? $500,000. So now they've had my money for 20 years. How much money have I received back? You got it, my principal. Then I go for another 10 years. That's another $50,000 per year. That's another 500 grand. So that's $1 million that I got out of the product over 30 years. Over 30 years. So it took me 30 years to double my money. There's no 7%, 5%. Be careful. However, if you want to make sure that you have a guaranteed income for life, this could be the product for you. But however, go with a fiduciary that there's no commissions. You can get this at very dirt cheap cost. But your internal rate of return is 2.2% in that scenario. 2.2% in that scenario. That's something that you don't want to do. Big Al, I mean, this is what's going on out there.
Well, it is, Joe, and really the next point we want to talk about, really getting into some of the obstacles that people are facing in retirement, is taxes, is high taxes. And when you think about it, how can you reduce your taxes in retirement? Well, that's utilizing a Roth IRA. A Roth IRA is a special kind of retirement account that grows 100% tax-free. You do not get a deduction when you put the money in, but it grows tax-free. This is the key. If you can keep some of your retirement income tax-free, you can stay out of the higher brackets. How do you get money into a Roth IRA? Well, number one is you can contribute $5,500 or $6,500 if you're over 50, or you can convert. A conversion is actually taking money out of your IRA 401k and converting it to a Roth. And in that particular case, then you do pay taxes on that, but all future growth is tax-free. And as we talked about on the contributions, $5,500 for if you're under 50, $6,500 if you're over 50, but your income has to be low enough to be able to make those contributions.
Well, that's it. There's a lot of things that we discussed. Here's the mistakes. You're paying too high in fees. Secondly, you might not understand the products that you're getting into. Also, if you went to Comic-Con and if I interviewed you, God bless you. Third, make sure that you're taking a look at your taxes, because if you can reduce your taxes, you can reduce the risk. You'll have more fun in retirement because you're giving that much less to Uncle Sam. I appreciate you guys tuning in. Call us right now. This is your last chance to get a retirement income planner, 888-994-6257. That's 888-994-6257. Hopefully you enjoyed the show. Have a great weekend. For Big Al Clopine, I'm Joe Anderson. You're watching Your Money, Your Wealth.